Okay, today we will be discussing new concept related to expense. Last was depreciation. Now we will discuss today another concept of expense, specific expense, that is bad debt. Bad debt. First of all, the basic, the basis why it is expense, because of its name. Bad means anything which is not good, and anything which is not good in terms of accounting is always expense. We feel bad about that, so it is expense first of all. Now what is bad debt and from which it is related? Basically bad debt is related to our asset, that is accounts receivable. If there is accounts receivable, there is always the chance of bad debt. Now what is bad debt? Bad debt is basically the chances of not receiving the amount from account receivable. The customer may not pay. That is the concept of bad debt. So as for definition, bad debt is chances of not getting payment from our customers. This is what known as the concept of bad debt. That's why the accounts receivable is also known as debtors. Means if we have sold, Mr. A have sold anything to B, then he will make the entry accounts receivable from B and sales credit. So Mr. A will say that Mr. B is my debtor, means I have to receive from him. Now, maybe there are chances that Mr. B may not pay. So there is always a chance of not getting the payment from our customers. So this chance is known as what? The concept of bad debt. But in this case, there are two scenarios. We will look into these scenarios one by one. First scenario is that let's suppose Mr. X has made a sale to Mr. Y of dollar 100,000, and Mr. Y said that I will pay it you after 1 week. And when after 1 week Mr. X went to Mr. Y, then Mr. Y said, I have no money to pay, I have gone bankrupt, or even in other circumstances like type of gangsters. He said that I will not pay you anything, and whatever you want to do, just do that. You will not get your money. In this case, this amount of 100,000 becomes what? Bad debt. This is the concept of getting the bad debt, and it means that we have a confirm that our we will not get the money. It is confirmed by saying that when Y said that you will not get money or I will not pay you, then it is confirmed that our account receivable has proven bad debt and we will not get that money. On the contrary, number two scenario may happen again. Let's suppose Mr. Y decided to become a good man, and he went to perform Hajj, and after coming back from Hajj, he said that I will not do anything like that, and I will do honest dealings with the man, with the business, and I will not repeat the things which I had done. Fine. He again went to Mr. X He said to Mr. X, I had done many bad things to you. Now please forgive me, and we will start new beginning. Let's start dealing with me, and I will pay you the amount, whatever is the time period or credit period. Mr. X will think for a while and said, okay, now he is saying that and seems to be a good man. Let's start dealing with him. So again, Mr. X sold goods to him, make a sale of dollar, let's suppose 500,000, and give him a credit period of around 2 weeks. And Mr. Y went his home. But in this case, what will happen? The moment Mr. Y leaves the premises of Mr. X, Mr. X will start thinking that his, according to his previous record, he will have a little bit thinking in his heart that Y may not pay again, or Y may not pay half of the amount, or Y may not pay the sum of the percentage of the amount. So he will think, it is not confirmed yet, but he will think during that credit period that it is probable, it is possible, or it is estimated that Y may not pay some percentage of his the due amount due, but it is not yet confirmed. Understanding the two scenarios. In first scenario, we have confirmed that our amount will not be received and it is a bad debt. But in the second scenario, it is not confirmed, but we are the seller, the X, Mr. X, is estimating that, making a possibility, making a booking in his mind that some percentage of the amount may be proved as the bad debt, but again, it is not yet confirmed. So there are two scenarios in which one case is the confirmation, that is amount will not be received, and the other case is that it may be on the basis of some past experience, on the basis of some market conditions. If there is a recession and economy is down, then obviously there are no payments, there are no employment, there are no payment, no room for wages payment like this. So there are provision, there are possibilities that amount will not be recovered. So there are two circumstances. Any issues in these two circumstances?
No.
That okay. The one now, the one in which there is a confirmation that we will not get a payment, it is known as a write-off. Write-off means now it's time to write off Y amount from our accounts. Means they are 100% uncollectible. So we have to write off his account. The second scenario in which we have made just estimation. So it is known as making or booking the provision for the bad debts. Provision means that is we are just making estimation that it is likely that some amount may there is may may prove bad. This is known as the provision or estimation. So the bad debts, that the collectibility from the accounts receivable can be divided into two categories. One is write-off and the other is provision estimation. For the entry of write-off, the entry for the write-off is different and the provision estimation entry is different. Let's discuss these two scenarios entries now. So we can divide bad debts into two things. Number one is write-off case. Number two is provision or estimation case. Done. In write-off means there is no now not an existence of that account. Mr. Y completely back off from his payment. So bad debts is the expense. Obviously, this is a loss. We will sad. We feel sad. So it will be what? Bad debt expense would be debited. And now, when accounts, when Y accounts existed, we had made the entry for accounts receivable debit like this. Now we have to write off it, we have to cancel it, so we cannot erase it. We have to reverse that entry, and for every debit, the reversal is credit. So we will cancel out or write off the account of Y in terms of accounts receivable credit Y. So his account will become zero. That we have made the write off of Y account. Now, what would be the provision? In the case of provision, it would be also bad debt expense. We have made in mind, we have made up our mind that such amount will not be provided. So also it would be expense, but it is not yet confirmed. So there is the estimation, and for estimation like depreciation, word is used allowance. So it would be used here instead of write off accounts receivable, we use allowance for bad debts. Done.
Yes.
Any issues?
No.
Okay, let's do the examples for it. Example number one. Bolt company sells different items to its different customers. The details of its debtors. Debtors means accounts receivable. The details of its debtors are as follows. A with the amount of dollar 10,000. B with the amount of dollar 50,000. And C with the amount of dollar 100,000. Among the debtors, A's account was proved to be uncollectible. It was estimated that 20% of these accounts may not be collected, and 30% of these account needs to be write off. What is the requirement? Basically, required is entries for write off, provision, and bad debts. Now, this is the requirement. So, first of all, in solving these questions, we have to analyze either which account needs to be write off and which account needs to be provided or make estimation for allowance for bad debts. The remainder is the just calculation of percentages. Then and we need to remember the entries for the write off and provision. Usually, what happens? Student used to learn that bad debt expense debit and allowance for bad debts credit usually, and forgot for the write off. But we have to carefully watch which account needs to be write off and which accounts needs to be made provision. So in this scenario, in this question, what is being said that among the debtors, A's accounts was proved to be uncollectible. Uncollectible means it is
Write off.
it is write off. So we can make entry at once, or we can make a rough entry. So we will do that bad debts expense debit and accounts receivable. And here it is very important to mention whose account is being write off. So account receivable A would be credited with the amount of 10,000. Then
Yes.
then what is being said that it was estimated that 20% of these accounts may not be collected. There are many indications that estimated may not be collected. So these all are indicating of what? The making of
Provision.
provision. So the 20% of these amount would be 50,000 of 20% of 50,000 is 10,000.
10,000.
Then again we will make entry bad debts expense debit, and now there would be provision for bad debt, and provision is collective, not for specific debtor, because it is obviously a provision, just provision. So it would be again 10,000.
Why is the crediting side not allowance for bad debt?
Sorry, it can be provision, it can be allowance, no issue.
Oh, okay.
Done.
Yeah.
Okay, now what is being said, and 30% of these accounts needs to be write off, again write off. So 30% of these account is
30,000.
30,000. That is bad debts again, bad debts expense debit, and now accounts receivable C credit 30,000. Now these are some separate entries, but we can also make a compound entry like all debits in one line and the credits, if they can be combined, we can combine it, or if they needs to be kept separate, then we will keep it separate. But here there are all like items: bad debts expense debit, bad debt expense debit, bad debt expense debit. So debit is plus. So 10 and 10, 20, and 20 and 30 is 50. So we can combine all bad debts expense in one line and in one amount, that is 50,000. Since the write-off of accounts receivable A and accounts receivable of C needs to be shown separately, that's why we will keep it separately. Accounts receivable A, accounts receivable credit C, that is A is 10,000 credit, C 10,000, 30,000 credit, and this allowance is separate item. So we will write it separately. Allowance for bad debts, 10,000. Now see whether the debits and credits are equal or not. If they are
Yes.
equal, then entry is 100% correct. So this is some way of sorting out or mixing the entries in one account to make a compound entry. Got the idea of the bad debts, how it is calculated, how the entries are passed.
Yes.
Now the next thing is that how this provision like this, that it was estimated that 20% of B's account was may not be collectible. So how this 20% is estimated? Why not 10%? Why not 30%? And why not 50%? Either it came in the dream of Bold company that the customer B will not pay 20% of the amount. So this estimation needs to be some basis, some rationale. And how this estimation is done, it is known as the estimation of all accounts receivable or all debtors is known as basically the customer's analysis or aging analysis, and the schedule is being made. We will discuss it in the new session. I am just closing it and log in after the you can log in after 5 minutes. Done?
Yes.
Okay.